Should you invest in high dividend paying stocks or growth based stocks? This is a common question that I get asked very often. Hi, my name is Arpit Arora. I'm India's leading personal finance expert and passive income coach, running two businesses, Ask the Wise Guy and TrendlineZ. TrendlineZ is registered with SEBI as a research analyst, and because of the skill that we have in this business, people always end up asking me this one question, that should they invest into certain companies which help them to create dividend or passive income, as I often say, from investment into shares. Now let's understand what are the sort of companies which offer this kind of a benefit, which offer this kind of passive income or dividend. So there are two different type of companies, one which offer a lot of high dividend and one which do not. Let's understand first is, should you do it or not do it, and what is the rationale behind it? What is the methodology, the concept behind it? I want you to understand first what is dividend. Dividend is a part of the profits which a certain company, rather than keeping it as a reserve, they are distributing it to the investors. That's what a dividend is. Now, most of these companies are typically government-owned companies, PSUs, are very well known for paying out high, fat dividends, some even to the tune of more than 4-5%. Now, looking at that seems very lucrative, doesn't it? Making 4-5% of dividend income just by investing into a certain company. And most of these companies are being a PSU entity, which is partially owned by the government. Sounds very safe to invest in as well. But this is exactly what I want to correct you on. If you're on the thought process of investing on the basis of this knowledge, I want to let you know that you're going to do a mistake in doing so. Why? Because understand, the companies which are actually paying out dividends are which companies? The companies who do not have further scope of growth. Because think about it, why would these companies not reinvest the same money into their own business for growth? Because they do not have enough growth prospects. They've reached to a level of saturation, they've reached to a level of height or peak in their business, that the money they're able to generate, that's great, but that money is not able to reinvest in itself. A lot of, if you look at small businesses, if you look at small business owners, entrepreneurs and other people, they're always reinvesting in their business, taking loans and doing whatnot. Why? Because they see a lot of scope for growth in their business. If you take it to other private listed companies on the stock exchange, they're also borrowing a lot of money, working on a lot of debt, but delivering a lot of growth as well. But these companies which pay a lot of dividend are those companies which have reached that saturation that they don't need any more money. The profits they're making, they have to distribute it to their investors so that investors stay happy, stay invested. So I never like to invest in these companies because there's so many other ways to invest to create passive income, to create a dividend based income. There are REITs, InvITs, there is different type of bonds. All of these instruments deliver great passive income, short-term passive income, which you can get rather than waiting to invest into companies which are PSU owned, high dividend paying, which also carry something that most people forget, is that they also carry a potential loss of value as well. Loss of value of the price of the stock. Why would that happen? Because the price of the stock is always a multiple of is always trading at a multiple of the forthcoming earnings or the past earnings. For example, if the last year's earning was say 100 crores and 50 times is the multiple of that company, which is the PE ratio, 50 times of the value of the last earning is on the basis of which the price is currently traded. So it has already, you can say, accumulated or anticipated the next 50 years of profit, and it is why trading at a certain value. So if the company is not able to grow itself, the revenues are not going to grow exponentially because the company is not growing and the company does not have scope of growth, which is why it is giving out all of this dividend. So in that sense, the likeliness of the growth of these companies is also less, which means the price of the fall will also likely stay the same or reduce. So your objective of investing in the stock is not met because other companies which are growth-based companies are consistently giving better financial results, growing more, and certainly the price of the stock is also going up. On the contrary, these companies which are PSU, which are giving dividend, but the growth in the stock is not happening. So the whole idea of low volatility and dividend is something you can get from debt with a higher rate of return rather than investing in these companies, wherein if you really have to invest into stocks, it is better to go for a managed product like a PMS or a AIF. We at Trendlines also have certain products on listed on small case where we do help our investors to invest in stocks, but they don't have to do it themselves. They don't have to do all that research themselves. On the contrary, if you want to do it yourself, you can better invest in indexes yourself. And those indexes are growing at more than a 12%, 15% rate of growth over the last 15, 20, 40 years period basis. And that in itself is also a great return. So one needs to become more strategic and more simplified. The word passive income only becomes passive if you're not too much involved in the buying and selling process, which a stock investor or trader is not. They're always actively involved. Second thing is you want to consistently make money out of it, which most people are not able to. So either find a systematic way of doing it, which is index investing, or invest in structured products on small case or PMS or AIF through which you can invest in stocks but not do it yourself. And then most importantly, let go of this thought process that investing in PSU companies for high dividend is a safe way of investing. It is one of the sure ways of eventually losing money out of it, because you are betting on the company to not do well, which is why they're paying you the dividend in the first place. So I really hope you enjoyed a different perspective in this video. It gave you a lot more information than what you already know about investing into stocks, and most importantly, it sets the tone for your future decisions that you're going to make with money. I really wish you for the best of health, wealth, and well-being with this. And most importantly, if you're learning anything out of this video, ensure that you comment, let me know what you've learned, share it with someone who you think can benefit, and most importantly, subscribe to my channel so you can get more amazing videos like these. See you in the next video.